Sharmila Whelan, the Deputy Chief Economist at Asianomics as well. Hi Sharmila, thanks for taking your time out and speaking to us at ET now. Look at what's happening across the board. It's a global mayhem that we are seeing. US stocks have also halted trading for 15 minutes. This is the third time that we've seen the circuit filter being hit. How do you see the whole situation now panning out? What do you think the investors should be doing? What are you telling people? And where from here? I mean, do you think over the next 2 to 3 months that the whole nervousness around coronavirus is only going to get more exaggerated?
The nervousness is going to get exaggerated. If the markets are selling off, it's with good reason. Until recently, the base case was that the effects of the virus would mostly be felt in the first half of the year, and demand would be delayed rather than destroyed, and it would rebound in the second half of the year as manufacturing supply operations returned to normal and the consumers came back to market. But now the worst case scenario is becoming the base case scenario. The worst case scenario is that the longer the virus spreads, you're going to see a collapse in corporate profitability globally. And on the back of that, what you would see is rising job losses, cutbacks in investment spending, cutback in consumption spending, i.e. a destruction of demand. And then we're looking at a global recession. And this is becoming increasingly the base case.
Oh, absolutely. You've really put it very succinctly that there's going to be a lot of disruption in terms of economic activity, and which is perhaps also the reason that the US Federal Reserve's steps have completely been ignored by the markets as well. What kind of fiscal response do you expect from the policy makers at this point of time? And most importantly, do the policy makers even realize what has hit them, if I should put it like that?
I think they are beginning to realize, but the response has been very varied from region to region. Asia has led by China, has responded very, very quickly, and that's why we believe that China will be coming out of the downturn the fastest. And as we know, production is returning to normal already, and it will be rebounding in the second half of the year, and that will pull Asia up. The epicenter has moved from China to Europe. I think Europe, especially continental Europe, in terms of closing down countries and borders and adopting draconian measures to contain the virus, have been effective. The US, where I expect the epicenter to move to next, is still in total chaos. In terms of policy response measures, I'm basically of the view that cutting interest rates isn't going to help. Injecting liquidity into markets, it depends upon where you are. If you look at Europe, which has had massive quantitative easing, and you look at commercial bank reserves, excess reserves parked at the ECB, which are running at 1.5 trillion, there isn't a liquidity shortage, right? So Europe, again, the US, you got to ask, how is cutting interest rates going to help, or expanding, asset purchase programs? What does help is what a number of other central banks have done, and acting in conjunction with governments, including the UK, which is to help businesses, right? Open emergency credit lines, extend short-term working loans to them, which are default on which is guaranteed by the government, because that's what you need to do. Defer tax payments, cut social costs, cut rentals, and help shore up businesses, because if we're looking at a global recession, that's going to be coming from a profit-led downturn. And so it's all about helping businesses. And there, I think the monetary policy responses have been very, very mixed, and largely are going to be ineffective.
Absolutely. In fact, let me just go back to the US markets. Dow has resumed trading. It's once again down by close to 12%. It is at 13% at the second trigger will also get hit. So we're keeping a very close watch on how things are panning out with the US markets. But, Sharmila, you were making that very interesting point on, the kind of impact that the economic activity getting stopped is going to have on the global economy as well. What is the number that you are penciling in? Because from IMF to World Bank, everybody's been talking about how there's going to be at least a 1 to 1.5% kind of an impact that we will see globally. What's the number that you're penciling in?
Actually, we don't do a forecast, and particularly at a time like this, the forecasts are not worth the paper on which they're being written, right? This is the virus, the pandemic we're seeing is unprecedented. It is unfolding right now. To put a number on it, to be able to quantify it, is impossible. It's more about understanding the shape of the downturn we're looking at and what kind of recovery, which is, I think, more useful, and understanding where government responses and central bank responses are going to be effective and where they're not going to be effective. And, I'd like to leave it at that. So sorry, I don't have a number for you.
Okay, if things were to get better, everybody's been talking about how we may not see a V-shape or a U-shape recovery anymore. It's time we take heart from the fact that it's going to be an L-shaped recovery. Do you concur with that view?
I'd agree with that view. I mean, if it was a case of just demand being delayed, then we are looking at a V-shaped recovery, and that's what was the consensus until probably about 2 weeks ago. Now because we're looking at demand destruction led by a downturn in the corporate profit cycle globally, we're looking at a more U-shaped recovery, right? And if the psychology of fear persists and that keeps consumers at bay, then monetary and fiscal policy is going to be either ineffective or it's going to work with long lags. So that's going to worsen the downturn. There aren't a whole load of policy tools out there. Given that we're looking at an extended U-shaped recovery, in terms of geography of how it's going to recover, it's going to be first China, led by Asia, Europe with probably a 1 to 2 quarter lag. In the US, I would say we're looking at a 2 to 3 quarter lag, because the US, the coronavirus outbreak is still unfolding there. It's looking increasingly that the peak could possibly be pushed out to the third quarter, which means the economic fallout will continue most of this year.
Right. In fact, this is the worst rout that we've seen for Dow Jones since 1987. This is really unprecedented, Sharmila. In terms of the emerging markets, look at what's happening globally. In terms of emerging markets, a country like India, how does India stack up? While, yes, crude prices are down, Brent is hovering near close to $30 per barrel. It bodes well for our macroeconomic situation. But if the global demand collapses, that's going to have an impact, a massive impact on the Indian economy as well.
Yeah, of course. India is very much a part of the international global economy. So, of course, it will have an impact. It would have arguably less of an impact than it would have on a lot of Asian countries, which are much more export facing. But I would say with India, India's problems are homegrown, right? The coronavirus is a double whammy. And if there's a downturn in the global economy, that's an outcome of it. But India's problems are homegrown, right? In India, the corporate profit cycle has gone into downturn. The credit cycle has been in downswing since 2016. So normally we would have said if the Indian business cycle was looking up, then we would say that the impact would be more muted. But this time round, yeah, sure, the lowering of oil prices is good for inflation and discretionary spending. It gives the RBI scope to reduce interest rates further. But this time around, India is in a much more vulnerable position due to its own internal dynamics compared to the eve of the great global financial crisis.
Absolutely, but Sharmila, I do understand, and I know that you will not speak to us on the what's happening in the commodity markets. But just to take away from what the point that you were making on the RBI, we did see today the RBI. They had a press conference, but steered clear from going ahead and reducing rates further. Is there also an admission that there is very little that monetary policy also can do at this point of time? And in fact, the RBI going ahead with forex swaps and also LTROs perhaps is a better measure, and they will take a call on rates maybe, when these kind of measures will actually lead to some kind of an impact on ground?
I would tend to agree with it. I know that there was wide expectations that the RBI would move in lockstep with its global peers and cut interest rates today. But I think what is much more effective is injecting liquidity into the system so that it is well supported. And again, the point that RBI says that there is enough liquidity in the system, the numbers bear that out. Cutting interest rates at this stage, I think, is going to have no immediate impact, right? Because it doesn't solve the problem with the underlying problems of the Indian economy, which is the corporate profit cycle has reversed and is in downswing. On the back of that, private investment spending, the cycle is again in downswing, and there isn't an appetite, particularly from the corporate sector, to borrow. So cutting interest rates in those circumstances don't really help. But to combat the coronavirus outbreak, injecting in liquidity and hopefully followed up by opening up emergency credit lines to small and medium-sized businesses would be a lot more effective. Having said that, I do expect the RBI to cut interest rates during the course of the year, but not immediately as we've seen right now.
Sharmila, in terms of sectoral impact, globally we're seeing how tourism, hospitality, airlines all seem to be in deep pain. What is it that you would expect the policymakers to do for these sectors specifically? Because we don't know for how long will this kind of pain really continue. Do you foresee that this is going to really lead to another 2008 kind of a period where we saw job losses, where we saw recession, hitting policymakers?
I think a lot of comparisons are being drawn with 2008, and there's commentators going so far as to say that this is worse than 2008, and in a sense it is. Simply because this is not a financial crisis, right? It is not a financial crash which can be dealt with. This is, a coronavirus. It's a health crisis which is unknown and uncontrollable. Again, within that, it's got the whole psychology of fear that's going to keep consumers at bay, as we were discussing earlier. And in the face of that, giving consumers more money, vouchers, or is going to make no difference if consumers are sitting at home. So the fallout is very different to 2008, 2009. The other second point to make is that the policy levers are much weaker today than on the eve of the global financial crisis, because interest rates are at record lows already, and therefore what we're seeing is that lowering them even further is pretty ineffective. There are also limits on fiscal policy expansion in a number of countries, including India, which is constrained. So it's a very, very difficult situation, even more difficult to predict. But I'd say that the prospects of a global recession are very, very high, if not a given at this stage.
Oh, absolutely. And that is, of course, the big worry, whether the policymakers have the kind of ammunition at this point of time, because this is not a financial crisis that we're dealing with, it's a health crisis. Sharmila, Donald Trump a couple of days ago did say that, you don't have to buy so much, relax, things are going to be okay. Do you think these kind of statements at all, help in assuaging the panic, the kind of nervousness that's there, across the board at all?
It's human nature, right? It's, panic sets in. It's very hard to keep a control of. From what we're seeing and hearing out of the US, the US is pretty panic stricken. Here in the UK, the government is, from today going to be doing a daily update on the coronavirus, and the whole aim is to assuage panic by keeping people fully informed. But that doesn't, is not stopping people from stockpiling. I think you'd have to see the numbers peaking in Europe before fears are actually addressed, and in turn, the whole hoarding and stocking behavior is actually impacted. Because right now we're staring down an abyss, not knowing how deep it is.
Oh, totally. We're staring into an abyss, and nobody knows that when is the pain really going to go. But Sharmila, at this point of time, do you believe, mostly people say that gold is the safe haven. Do you concur with that view, that even during these times when you don't know the level of uncertainty, the level of nervousness that's there, would you still see gold to be a safe haven in times like these? We're seeing the kind of rout that's there in equity markets, the rout in the commodity markets as well, on account of the collapse in demand. But is gold really, still going to be the shining commodity that people would treat as a safe haven, or would it be the government securities?
I mean, gold was pretty clear cut after the global financial crisis, right? Because you had quantitative easing that devalued the dollar, and no one wanted to put money into stock markets. Bond markets, yes, but it was really the devaluation of the dollar that led to the switch into gold, and gold did very well, straight cut. I think, again, this time around, it's unclear, right? Because you can't use that same logic and apply it to the current situation. Right now, we're facing a health crisis, which is very different from a financial crisis. And I would say cash is king.
All right. On that note, Sharmila, always a pleasure chatting with you, and thanks for getting in your perspective on ET Now. That was, of course, the special show that we had for you, telling you all what you need to do during these times.